Hey traders, Raghee here. Welcome to Charts and Coffee. Happy Monday, everybody. Hope everyone's doing great. We have a pretty boring week in terms of data, which, when you consider what we have coming up the week after, gets a whole lot more interesting. Not so much in that we're going to expect anything other than a quarter point hike from the Federal Reserve next Wednesday. So basically, 10 days from now. But rather interesting because we're looking for any kind of insight into what the Federal Reserve might do for the latter part of the year. Is there one more quarter point hike in store? Not so far. That's not the probability. It's a possibility, but then so are aliens hovering over Manhattan, right? So we don't want to work on what the less likely possibility is, although, obviously it's possible, but the probability is for that hold. So we want to keep that in mind. In terms of what we're dealing with from Friday's action, there was a lot made in sort of financial circles about Friday's candle and what that could mean about today, Monday. And one of the things we talked about in our Sunday show, our top tier market outlook show, said, look, yes, that's the potential for a minor high, but it's a potential for a minor high within the context of an overall uptrend. So does it mean this is the beginning of some sort of cataclysmic move to the downside? I would think at this point, the uber bears right now would just say, look, we were either wrong or we were early. However they want to accept reality, because this is an uptrend in the S&P. We've had an uptrend in the S&P since June. We've had an uptrend in the NASDAQ since the end of April. And probably the most significant move that we saw from Q2 to Q3, from the first half of the year to the second half of the year, is this move in financials. And it means a lot to the S&P because the S&P had been carried higher overall by the strength in tech, right? So tech is able to carry the NASDAQ, obviously, and the S&P without financials and without healthcare participating. But if we imagine lifting the hood on the S&P, you see three cylinders: XLK Tech, XLF Financials, and XLV Healthcare. 2 out of 3 are moving along. That's only going to make that performance that much better, as opposed to just one cylinder, if you will, just one sector. So this move in healthcare is significant. I don't care about that Friday volatility. We had earnings, right? We had earnings. We're coming into that very early part of the earnings for financials. Aside from that, this is an uptrend as of the 6th of July. And I think even more importantly, since the 30th of June, which is not just any other day, but the last trading day of Q2, we were able to break that 200 exponential. A lot of good things happening in financials, and that's going to continue to very likely be a nice machete through the path of the jungle of chop when it comes to the NASDAQ, already in place, and the S&P starting to participate with it. That's where we are right now. And I will continue to look for bond yields to drop, which is to say, let's see if bonds can't move higher. And a lot of questions about the dollar. Gang, anytime we have, and for those of you in the Sector Secrets Mastery, we've been bearish the US dollar for, since last year, right? There's been no reason to get longer term bullish on the US dollar. Sure, will rally. But when we rally into something like the 200, those are opportunities to either buy euro or short the US dollar index basket. Why is this continuing to work? Because the European Central Bank is still very much underway in their hiking cycle. The US is just about done. Euro strength is going to lead to dollar weakness. A central bank winding down a rate hiking cycle is also going to be weak to the currency of that country. So for any number of reasons, mostly focused on the Federal Open Market Committee and the European Central Bank, we're going to continue to see euro strength and dollar weakness. Does that bode well for equities? It sure ain't going to hurt. All right, gang. So let's go ahead and jump into our questions. As always, thanks so much for being here for our Charts and Coffee show. Got a little espresso this morning. Ketones in there. Pretty good stuff. All right, let's get to it. Stephen asks, good morning. I am doing well. Hope you are doing well as well. Would like to know when you are having a course in day trading or swing trading. I really like my process for now. Oh, I appreciate that, Stephen. Um, I'll have, Stephen, I have a class coming up in October, I believe. But I got to tell you, Stephen, at the end of this month, in probably less than 2 weeks, I think it's September, October, I'm going to have a class, but we also have a trial to the Sector Secrets Mastery, which is an entire month with me for, I believe, $7. So I want to give you a heads up on that as well, because then you get to hang out with me every day, well, Monday through Friday, and watch me handle what we're seeing here, macroeconomically, technically, from a trend perspective in the current environment. So I appreciate that. Thanks, Stephen. And I believe it's going to be October, right, for the day trading class. All right. Um, let's see. Thank you for the great work. No, I appreciate that. It was funny. I have a Twitter friend, right? We have real life flesh and blood friends, and then we have some meaningful relationships with folks on social. And I have some really cool Twitter friends that I get to see from time to time. And one of them said, hardest working girl in trading," and you should look her up. Her name is Anne Marie, and Anne Marie Trades on Twitter. And Anne Marie hustles too, and it's really funny. And I'll go back and forth with her and a lot of my other social media friends. We would be trading here in our office, regardless of whether or not we had a cool audience and a community to talk to. This is what we do, right? But then on top of that, we get to share with hundreds, if not thousands, of like-minded traders who want to slay it at this game. Yeah, it's my pleasure. It's my job and my pleasure. I mean, what a gig. I'm very grateful. Yeah, for sure. I appreciate that, Stephen. So yeah, heads up for the trial that's coming up later on this month. I think we're going to have the link. The Trish boss should have that link for me in the next week or two. And then I have a class in October. All right. Nick asked, does it seem to you that the US dollar is rejecting 100 and getting ready to go lower? My friend, it rejected the 200, I don't know, about 3 different pockets. Yeah, it's already heading lower, right? It's already heading lower. So in terms of what do I want to do now, Nick, I would shorten the time frame, because we've already made such a dramatic move on the daily time frame that I don't want to have anybody shorting the daily at the lows. I need a bounce, right? And if I'm looking at a bounce on the 60, it's going to be easier to come by, and it will require a much smaller bounce. If not, I need something up towards 101, maybe even 101 and 3/4. So 101.20, 101.30, to even say 101.70. However, if I look at the 60-minute time frame, I might have different opportunities in terms of where a usable bounce could occur within the context of a downtrend. I could have a 60-minute, say, reversion to the mean at the wave. I could have a 60-minute 200 propulsion. So I would say, yes, it's probably going to head lower. But, look, frankly, that was from the 103 handle south. So now let's shorten the time frame, maybe even to a 5-minute. By the way, the flip side of that, Nick, remember, long euro is the absolute same thing as short US dollar. The US dollar is a high concentration weighted basket of currencies, and 58% of that thing is the euro. So there might be opportunity there as well. Thanks for the question, Nick. All right, moving on to is there a Magnificent Seven ETF, and what is the symbol? Is there an ETF only made up of those 7 companies? Daniel, there are plenty of ETFs where the high concentration weighting is in those 7 companies. I mean, the NASDAQ would be a great example. I don't believe there's an ETF of only. And so for those of you wondering, what is the Magnificent Seven? And I've been talking about that, I guess now for about a week. And that is Apple, Microsoft, Meta, Alphabet. So both the Goog and Google. So Meta, Alphabet, Amazon, Tesla, right? And so the 7 come from the 7 companies, right? I would throw NVIDIA in there as well. And so you've got these 7 companies, 8 stocks, right? 8, 9 stocks, depending on who you want to add into that high concentration weighting, that are disproportionately representative in the S&P and in the Nasdaq, but it's the Nasdaq that's having the rebalance right now. So I mean, I would consider I would consider the Nasdaq still probably one of the best representatives of high concentration weighting in those names, Daniel. Yeah, and even though it's dropped from about 55% to say 40%, it's still hugely concentrated in those names. It meaning the Nasdaq. All right, Matt says I'm in Microsoft. Okay, let's jump on over there. For pre-earnings, would like my outlook on this week, one contract. So, Matt, if you checked out my Friday video and even Countdown Trader, my approach to earnings is not about this week or right in front of an event. That being said, for those of you saying, okay, Rog, what is this window in terms of, let's see, where's my estimise? Where the heck is it? No. There we go. So what we're looking at here, and I use a site called estimize.com, and here's why I use it. Number one, it's a free service. Number two, it lets me track stocks well ahead of their earnings. So if you take a look at what we have coming up, tomorrow's Bank of America, we have Lockheed, Merrill, PNC, Halliburton, IBM, et cetera, et cetera. And then if I head on over and just do a quick search for Microsoft, right, I've got 8 days. I've got 8 days. So this is going to be the 25th. So this is the day before FOMC, which presents its own kind of craziness. However, this is actually too close. You know, it's right inside the window. For me, it's got to be 14 days before, but this isn't terrible. At least it's not tomorrow or 2 days, right? So that's not terrible. But for me, I'm going to buy the dips into the earnings. So for example, if earnings are the 25th, so I'm going to drop a vertical line right here, right? On earnings, right? So 25, so let's go back 14 days. I go back 14 days, and if I want to focus on it, and it's right there at the cutoff, right? I've got to get a pullback buy in Microsoft, pretty darn close to that date, right? So if I think about, oops, and I'm actually doing that wrong. It's the 11th. So I've got to get a opportunity inside, no more than 2 weeks. Why do I want no more than 2 weeks? Remember, as we get closer and closer to earnings, by the way, unless you're a trader, Matt, that sells premium where the implied volatility starts to go up and collecting credit on an option into earnings starts to be actually a little bit more favorable. If you think about the scales of a long call buyer versus say a long call seller, the premium starts to favor those who write premium, write credit, right? Are selling options. So for me, if I can start, heck, even going back a little bit more, let's go back to the 25th of, here we go, 25th of May, right? From that point on, that's 4 weeks before earnings, I'm going to buy dips. I'm going to buy dips into the DPMR. So I'm going to have a lot more opportunity to cycle, buy the dip, play the rally into earnings as opposed to with 8. But that's what I would have to do in terms of, what would I expect Microsoft to do? I would expect it to keep moving higher, but as we get closer and closer to earnings, the psychology is going to change a little bit. Traders might take profit. The implied volatility is going up, so it's going to change the nature of movement. But I would expect it to continue to move higher, Matt. That's the way I would look at it. But I would rather start the process, 6 weeks, 4 weeks, 2 weeks, right in that window. All right, editor, I have the risk management in place to manage losses. Awesome. But do I have any advice on how to handle losses mentally? Editor, this is a very succinct answer, but definitely the only answer as far as I'm concerned. How to handle losses mentally. It's really a twofold process of realizing that nobody wins all the time. That's just something that I think amateurs think, and I know you don't think that at all, but that's something amateurs think about professionals, that, oh my gosh, hedge fund folks don't, do anything but win. Not true. I think, though, the most important thing is, how do you handle losses mentally, is take them. You may, wait a minute, Rod, what do you mean take them? Take losses while they're small. Paper cuts sting, they're supposed to, but you have still full use of all your digits. Yes. What happens to most traders is they take outsized losses, right? Especially in small accounts. The management on small accounts is some of the most atrocious mindset that I've ever seen. This idea that I want to take a tiny account and grow it very quickly is absolutely delusional, right? So that's probably one of the most dangerous slippery slope. I'm just pointing that out, and it's very much exaggerated in that place. Most traders would be very well served if folks like me just said, no, you should not be trading a tiny account. It's going to put you at a disproportionate disadvantage to other well-funded traders in the market. Come on back, keep learning, keep building the account. That's the real advice, right? When it comes to small account. What about everybody else? Take small losses. Take them while you can, not when you have to. And when you can get good at those small losses, you'll realize it's just a part of the game. And that's the path to never blowing up an account. And that's the path that I was taught early on. That's the path that I pass on to others. I've never blown up an account, not because I'm a brilliant trader with a 99% win record. I mean, who has that? We all have moments of brilliance and we all have moments of brutal trading, but I don't take disproportionate losses to my account. And if you have the formula that we teach in the Sector Secrets Mastery, that's exactly the formula that I was taught over 2 decades ago. That's led me to a place where I can say, look, I've had losing months. I've had losing days, right? I've never had a losing year, and I've never blown up an account. And even if never having a losing year means I made 2% that year, I did not blow up. And that's, to me, it's that longevity and that consistency, right, that we're after. That nice smooth P&L from the left to the right corner of the screen. All right, next up, I'm interested in the trial. If the US dollar is down, it helps the IWM to be up. So what's really interesting about IWM? It actually does better compared to the S&P when the dollar is strong, because small caps are usually domestic stocks. International stocks will struggle sometimes if the dollar is strong, but everything benefits when the dollar is weak, quite frankly, in terms of equities. There are some interesting correlations, though, to small cap, and I'm actually going to be writing about that in this week's. It's funny you mentioned that, Raphael. We'll have the This Week in the Markets newsletter out later on this afternoon, but my second topic, Raphael, this week is small caps, high yield, and regional banks. And I'm going to talk about the nature with which those move together. High yield and small cap actually has a pretty interesting correlation, but everything's going to benefit, not just domestic. Everything's going to benefit before the, in terms of before the U.S. central bank stops hiking, the dollar is already weak. I think everything's going to benefit. Matt says, oh, okay, you're up on that Microsoft and intend to be out before the call. Beautiful. Matt, well played, right? Well played. You put that position in already, which I love. Excellent. No, excellent. Well traded. Well traded. All right. And you bought last week during the dip. Makes me so happy. Makes me so happy. All right. So one of the things that I want to mention, and I think this is a great place to kind of end the conversation. What size account do you recommend to start with? I believe options traders, especially options day traders, have the luxury of starting with a smaller account. I think 5,000 for options day trading, long calls, long puts, in a cash account, which I recommend, is very reasonable. If we're going to go into futures trading, it should be more. Really minimally 7,500 to 10,000 or more, right? Futures are highly leveraged. And if you're going to day trade futures, you can do that. If you're going to swing trade options, if you're going to swing trade futures, meaning overnight exposure, I think, again, you need a larger account. So while I know it's very tempting to sit here and say, you can start with any size account, that's not true, right? One of my mentors told me exactly what I'm telling you right now. Start properly funded. right? Otherwise, you're always going to be struggling. So in my mind, keep learning, but keep building an account on the side till you can come to the market with really a fighting chance with a reasonably sized account, right? I know there's all sorts of exciting stories about what folks did in 2020. Gang, certain types of market environments can allow traders to have those kinds of returns. But the kind of environment we're in right now, please don't start underfunded. It will only lead you to blow up an account by taking unnecessary risks. So, Buki, 5,000 for long calls, long puts, day trading, options, futures, I'd be 7,500 to 10,000. Much more leverage, much more volatility, much more risk. All right, gang, be good to each other. My Sector Secrets Mastery folks, I'll see you in just a few moments. I'll see you tomorrow. Same time, same station.